Okay, looks like we've got a pretty good audience built up now. So good afternoon, everybody. Thank you for joining this InvestEngine webinar in partnership with Invesco on how to invest globally. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I am joined today by Chris Meller, who is a product specialist at Invesco. Now, in terms of the plan for the webinar, I'm going to hand over to Chris in a second. He's going to go through a bit of a presentation all about global investing. That should take us to about 12:30, maybe a bit before. And then I'll give a quick run through on how you can buy the ETFs, which are related to what Chris has been talking about on the InvestEngine platform. And that means we should have about kind of 5-10 minutes at the end for Q&A. So wrapping up at about 12:45, 1:45. If you want to ask questions as we're going through the presentation, you should be able to click on the little Q&A button at the bottom of your screen. The questions, they're not going to be broadcast to the whole webinar chat. They just come straight to us. So don't worry if you think you've got a stupid question. That's absolutely fine. Feel free to ask away and we'll answer as many as we can at the end. Yes, we have the usual disclaimer on the screen here that your capital is at risk whenever you invest. This is for UK residents only, and that none of this is financial advice. So with that, I'll hand over to you, Chris, to get us kicked off with the presentation.
Perfect. Thank you, Andy, and thank you for inviting me to join this call. I guess you'll see that with two companies involved, there are two sets of disclaimers. So, before we get into the weeds, I've just got to remind you that all investments obviously involve risks, and the key risks for our products for this particular product are on the screen right now. And obviously, if you need more time to look at that, you can visit our website where all of the risks are detailed in triplicate, I guess. So that done, what I'm going to talk about today is focused on the Invesco FTSE All-World ETF. I'm going to use the fund and talk a bit about the case for using that fund in a portfolio, the importance of diversification, and how you can get a broad, diversified, low-cost exposure to global equity markets. On your screen now, you can see a quote which is attributed to the Nobel Memorial Prize laureate Harry Markowitz, saying that basically diversification is the only free lunch in investing. And we're going to start off by taking a bit more of a look at that diversification point and why it's important to investment performance. So Markowitz made this comment largely as a riposte to the observation by Milton Friedman that there's no such thing as a free lunch in economics. I guess the important difference there is one's talking about economics and one's talking about investment. So what Markowitz did in his 1952 paper, which was entitled Portfolio Selection, was basically to demonstrate mathematically what I think that most people will be familiar with. Everyone knows the old adage that you shouldn't put all your eggs in one basket, and that's ultimately what diversification is doing for you in a portfolio. The key observation that Markowitz made was that you can reduce the risk in a portfolio without necessarily reducing returns, or certainly up until to a point, but ultimately by removing idiosyncratic risk and getting portfolio risk, so taking out specific company risk and focusing on the broader market exposure, is ultimately what diversification is giving you. If we jump to the next slide, we can see in a bit more detail exactly what Markowitz was talking about in that paper that I mentioned. And he made two observations and basically worked out the maths that showed this. The first around anticipated returns for a portfolio, and the second around anticipated risk. So anticipated returns are driven by the performance of the underlying holdings and the weight that you put into each holding. Fairly obvious and fairly intuitive. If you have two stocks in your portfolio and they're both held in the same weight, and if one of them doubles and the other one goes nowhere, the value of your portfolio will go up by a half, but all fairly straightforward. What's more interesting is what happens on the risk side. So it's a little less intuitive as ever with these things. The first thing he observed is that risk itself is driven by two key factors. The first similar to the portfolio performance, it's driven by the volatility of the individual stocks or individual portfolios you're holding, and the weight of each of those in the portfolio. It's actually driven by the square of those two values. The second observation he made, though, was that risk is also determined by the correlation between the holdings in the portfolio. So the weight of those portfolio holdings, the volatility, and the correlation have a part to play. What do I mean by correlation? Well, correlation is simply measuring the performance of two assets and looking at how those are interlinked. Mathematically, correlation ranges between +1, where two assets are perfectly correlated and they move entirely together in lockstep, down to -1, where the direction of movement of those two assets is perfectly negatively correlated, so they move in the opposite direction to each other at all times. Obviously, it's very rare to find assets that are perfectly correlated or perfectly negatively correlated. Typically, you'll find correlation sits somewhere in between. And just so we're clear, if you've got a correlation of 0 in terms of the calculation, that's showing you that there's no consistent relationship at all between those assets. Ultimately, what Markowitz observed was that if you introduce assets into a portfolio that have a low correlation with each other, it means you're going to get a lower risk for the combined portfolio. Interestingly, you can even add more volatile assets to the portfolio, which you would normally intuitively think is going to increase risk. But if that asset has a low correlation, or indeed even better, a negative correlation with the other holdings that you have in the portfolio, you're going to get a lower risk or lower expected risk from that portfolio. So I guess the next question is, what does this mean for the real world? And if we jump to the next slide, what I'm showing on the screen here is the performance of various regional benchmarks, and also the correlation of those various regional benchmarks to the UK market. So if we look on the left-hand chart, and let's talk about performance first of all, the obvious thing around investment is that certain investments will do better than or will do worse than others. And I guess part of the art of actively managing a portfolio is selecting those investments to try and pick the ones that are going to do the best. And obviously, if you have skill in doing that, then you're going to be adding value to your end investment outcome. I guess the key thing I'd highlight here is that from the perspective of a UK-based investor, and home bias is often a problem with investing wherever you live in the world. Most investors have a bias towards their local equity market or their local bond market. If you're a UK investor, over the last 24 years, or best part of 34 years. I can't even do basic maths. 54 years since 1969, the end of 1969. A UK investor hasn't done particularly well compared to an investor in other parts of the world. So if you had purely a UK portfolio that you started in 1970, about the only market of these broad regional benchmarks that you would have outperformed is Japan. All of these returns, by the way, are in sterling terms, so currency has a part to play here, and part of the outperformance that you've seen from other markets has been driven partly by the relative weakness in sterling over some of this period. But the obvious observation is, if you'd invested in US equities over the last decade, you would have significantly outperformed versus all other regions. It's also worth saying that if you'd invested in Japanese equities at the start of the 1980s, you also would have significantly outperformed. But if you'd held that portfolio, or indeed if you'd invested in the late 1980s or early 90s, you would have had a pretty horrible time of it holding just a purely Japanese portfolio. And so again, this sort of argues for diversification in exposure. It's great if you can pick the winners, but there is always a risk that you won't get the ongoing performance. And certainly, as we say at the bottom of every single slide when we talk about performance, past performance really doesn't predict future returns. And unless you've got a good insight over what's going to do well, a well-diversified portfolio is likely to be a better answer. In terms of correlation, and to go back to Margaret's observation that combining assets with low correlations with each other will reduce your overall portfolio risk. You can see on the right-hand chart here the correlation over time between UK equity market and the three regions on the other chart, so the US, the Japanese, and the Europe ex UK. And what you can see is that obviously, first of all, correlation varies over time. If we look back at the start, back in the 70s and 80s, you tended to see less correlation between regional equity markets as globalization has taken effect, and we've seen increased interconnectedness between different economies and different markets. You start to see a general increase in correlation, but again, it's by no means certain. Japanese equities are still relatively uncorrelated with UK equities, and indeed US equities. The correlation has dropped recently, primarily because US equities have outperformed UK equities rather than the other way around. And then finally, you'll find that an investment in European equities, perhaps unsurprisingly given the linkages between the markets or between the economies, tends to have a higher correlation with UK equity markets. So if you're looking to add, diversifying assets to a portfolio, and you're currently looking at a primarily UK-focused portfolio, Japanese, US equities are going to do a better job of diversifying risk than perhaps a European exposure. But nonetheless, even European exposure will play a role in diversifying. If we jump to the next slide, what we can look at here is the performance of a broad global diversified portfolio. So rather than relying on selecting individual country or regional exposures, what we're doing here is looking at what would be the performance of a theoretical investment, which is what an index is, in the FTSE All-World Total Return Index compared to the MSCI UK Total Return Index. And what you can see is that, over the last 30 years, on average, per year, you've seen something like 1.5% better returns from a global portfolio like the FTSE All-World than you would from a purely UK focused exposure like the MSCI UK. You can see that does vary over time. So, if we go back to the global financial crisis, actually a UK investment did better. And most of the gains that you'd seen up until that point, from 1993, which is when the data for this index starts, were given up during the global financial crisis. The UK was a relative safe haven during that period. But again, if we look back over the last 5 years, the returns on a global portfolio have been almost double the level that you've seen per year on the UK index, and certainly year to date, the US exposure in particular, and Japanese exposure, to be fair, in the FTSE All-World has helped lead significant outperformance versus the UK benchmark. Jumping to the next slide. I think it's worth talking a little bit more about what the FTSE All-World Index is and how it's calculated. And what the FTSE All-World Index is doing is basically giving you a market cap weighted coverage of almost 90% of the world's investable equity market. It consists of, I think, just under 4,300 large and mid-cap companies spread across both developed and emerging market countries. The only regional or country exposures that you're going to be excluding, or that are excluded from the FTSE All-World, are frontier markets, so more difficult to invest markets, less liquid markets, and indeed a few standalone countries The most obvious example of that, for example, is Russia, which since March 2022 has been a pariah in global investing circles, so is not going to be included in something like the FTSE All-World Index. The All-World Index is calculated and provided by FTSE Russell, and FTSE Russell themselves are a leading index provider. I think most UK investors are familiar with the FTSE name. Russell is has a very strong history in US index provision. They had a tie-up some years ago to become a sort of real global powerhouse in the index world. And they're responsible for calculating the performance of this index. And it's the index that we're tracking with the Invesco FTSE All-World UCITS ETF. Let's have a look at some of the characteristics of the index, and therefore the characteristics of the portfolio that the ETF is exposed to.
Sorry, before we move on to the next slide, can I just jump in with a quick question, please?
Yeah, of
the
course.
Top bullet point you've got on the slide there, Chris, it says that the index consists of 4,000 large and mid-cap companies. Do you get exposure to small-cap stocks as well, or is it just large and mid?
There's not a terribly meaningful exposure to small caps. I think there are something like 50 companies in the FTSE All-World Index out of that 4,300 that have a market cap below $2 billion, which is where we would normally use as a cutoff between mid and small. So in terms of index weight, it is de minimis. It's virtually zero. There's a very small exposure, but that comes as a consequence of index design. The way that FTSE is selecting the stocks that go into the index is based on market cap, so company size, and it's selecting for the largest companies down to the 85th percentile within each of the countries that it includes in its global investable index world.
Yeah, that makes sense. So you will hold them; they'll just be in a much smaller proportion because they are smaller companies.
Yeah, naturally. Yeah. And again, if you think about the size question, in terms of the exposure, large cap stocks make up something like 97.5% of the weight in the index. Mid cap is sort of 2.5%. And again, that's primarily a function of the size of the companies in the index and the weighting by market cap that the index is using.
Yeah, that makes sense. Thank you.
So if we jump to the next slide, actually, and thank you, because that's a good lead into the next slide, which is looking at some of the more characteristics of the index and what exposure it's giving you. So if we start on the left-hand side, you can see here a sector breakdown. And for reference, I've included the FTSE 100 index. So again, something that most UK investors will be familiar with. And you can see that, by broadening out to a more global exposure, you're getting actually quite a different sector mix. So the UK market itself is dominated by financial companies, so the banks and insurers, the household names that everyone is familiar with, consumer staples companies, and then industrials and energy. With energy, I guess shrinking in size over the years, but still a pretty significant component of the UK equity market, with the likes of Shell and BP, obviously, dominating the history of the UK market as well. If you look at the global exposure, you've got a similar level of exposure to financials. Financials are a key part of markets across the world, but less of a focus on consumer staples. Less of a focus on energy, and instead what you're getting much more exposure to is what you can see at the bottom of the chart here, which is information technology. So the tech sector, and we'll talk about this a bit more when we look at some of the top 10 stocks, and communication services companies that make up a much larger part of other international markets, in particular the US. In terms of country breakdown, you can see on the right there that you're getting about 60% exposure to the US equity market, and then the next two largest are Japan and the UK, with 6% and 4% respectively. A fairly large exposure to Europe in aggregate, but in individual countries, it's also each of them is relatively small. So it's giving a good globally diversified exposure as well in terms of geography.
Yeah, just a quick question on that one as well, please. Just
Yeah.
from the kind of InvestEngine perspective, we see a lot of newer investors tending to only invest in an S&P 500 tracker. Do you think that makes sense, or do you think it's still a better idea to get more global exposure?
Yeah, it's again, it goes back to that diversification question. If you think that the US equity market is going to continue to deliver the strong outperformance that you've seen, and actually, if we jump back a slide or two slides, 3 slides maybe, you can see, one more slide to the regional performance slide. You can see that strong outperformance that we've seen from the US. Basically since the end of the global financial crisis in sort of 2010, you've seen a number of drivers of that outperformance. Partly has been economics. The US bounced back more quickly from the global financial crisis. Partly it's been a market structure question. The US has a greater exposure to the tech stocks and the growth stocks of the Magnificent Seven that have made a lot of headlines in recent years. And I guess the key question is, if you think that's going to continue, then perhaps greater exposure to the US makes sense. If you're worried that it doesn't continue, then clearly the benefits of the diversification of having other exposures is going to save you from the pain that's caused by potential underperformance from US equities. And again, the cautionary tale that you always refer back to if you're looking at regional exposures is that Japan example.
Yeah.
Japanese equities were rampant in the 1980s, and it felt growing up in the 1980s, it felt like every Hollywood movie had a Japanese angle, with Die Hard having Nakatomi Plaza and all the rest of it. Japan was everywhere, and then of course the bottom dropped out of the market, and it then spent 20+ years in the wilderness, and there were clearly very different drivers of that story, but it does sort of give you the cautionary tale that even at a regional level you can have this sort of level of underperformance.
Yeah.
So yes, so if you think US makes sense, then including a greater US exposure is another approach you could take. And again, we'll talk more about this, but you could hold the FTSE All-World ETF as a core exposure, and then tweak your exposures around that with sort of satellite exposure. So if you believe more in the US, you can add some S&P 500 to your portfolio. If you're worried about the US, you could add some Japanese, UK, or European exposure through individual regional benchmark exposures as well.
Yeah, very sensible. Thank you.
And actually, talking about the US brings us on to the next slide quite nicely, which is looking at the top 10 weights in the FTSE All-World Index and in the FTSE 100 Index, again, using it as an example of the sort of the UK market exposure. So the first thing I'd say is that, one of the advantages of the FTSE All-World Index is that it is giving you a less concentrated exposure to individual stocks. So the top 10 stocks, again, are names that everyone will recognize, the likes of Microsoft, Apple, Alphabet, and Nvidia. That's obviously grown in recent years with the AI story. All of these are obviously top stocks in the S&P 500 that you mentioned, Andy, but they have a weight in the FTSE All-World of around about 19%. If we compare that to the weight of the top 10 stocks in the FTSE 100 Index, which is the sort of the first column of data on the right-hand table, the top 10 stocks in the FTSE 100, Shell, AstraZeneca, HSBC, etc., add up to almost 50% of the weight in the FTSE 100 Index. If you look to the top 10 stocks in the S&P 500, which you mentioned, that's the 500 largest stocks in the US, the weight of the top 10 stocks in that portfolio is around about a third, so 33%, has at the same date as the data on this slide. So, that diversification point, again, is coming through less exposure to individual stocks. So again, if you think that the move in Nvidia is overdone, then having a relatively lower weighting in that rather than the sort of weight that you're getting in the US index at the moment makes a lot more sense. If we jump on one more slide, perhaps we can talk a little bit more about what the ETF is doing, how it's structured, and also I think talk a bit about using it in a portfolio. So the ETF itself was launched in the middle of last year. As we've talked about already, it's giving exposure to the FTSE All-World Index, which is a diversified exposure to global equities, both developed and emerging markets. It's doing that through physical replication, so we're holding the stocks in the index as part of the portfolio in order to best track the performance of that global index. It's also giving a very low cost exposure to that. So to put that into context, you can see on the right-hand side there that the ETF is priced at 0.15%. Again, like I say, to put that into context, when we launched that was 7 basis points, 7.07% cheaper than the equivalent competitors in the market. And it gives a very efficient way of getting exposure without giving up performance to fees in a portfolio. In terms of using it in a portfolio, as I said earlier when we were talking about the US, one way that a lot of investors use something like the FTSE All-World ETF is as a core exposure or a portfolio. It gives you a good broad exposure to global equity markets. You're not taking big bets on any particular individual companies or indeed in individual countries. And then you can add to that portfolio through satellite exposures. We talked a bit about adjusting your portfolio by adding more US if you think that the US is going to continue to outperform, but still getting the diversification of having exposure to the other regions. The other way that a lot of investors use it is to add other equity exposures. So at Invesco, we offer a wide range of thematic ETFs, for example. So things like exposure to the biotech story or to the blockchain stocks. Clean energy has been another theme that's garnered a lot of attention in recent years. What you find with those more thematic type ETFs is that they tend to be more volatile than the broad global exposure you're getting with the FTSE All-World, but they also tend to have greater expected returns, which is the reason that investors would think about adding them to a portfolio and giving exposure to that sort of long-term growth story that comes with the individual themes that they're offering. As I said right at the start, Harry Markowitz's observation was that you can add higher risk, more volatile investments to a broad portfolio and actually potentially reduce the risk of that portfolio and certainly potentially improve the risk-adjusted returns of that portfolio if the correlation is low enough. So building portfolios with a core broad benchmark and then adding those satellites around it provides another sort of useful and easily managed way of adjusting your exposure to global equities. The final thing I was going to mention on this slide was the box in the middle there, where I highlighted the fact that we have a choice of currency hedge versions. So you can buy the ETF as a sterling listing on the London Stock Exchange, and the performance of that exposure will be basically the performance of the underlying stocks converted into British pounds. And obviously that means that there is an exposure to the volatility in currencies and the variability in currencies. Interestingly, that's actually worked to the benefit of a UK investor in overseas exposures over the last, certainly the last decade, as you tended to see currency weakness, so the pound being worth less compared to the dollar or the euro over recent years, which means that foreign company performance translated to English pound performance has been enhanced. If you think that sterling is likely to strengthen, or you just don't want to take the risk that it does, then investing in a currency hedged ETF gives you, share class of the ETF gives you a way of reducing those risks. It doesn't take out all the risks. There is still a cost to currency hedging, not least of which is that there's an additional 0.05% fee for the currency hedge share class or share classes, but there are also additional costs in terms of potential performance impact from interest rate differentials that is driving the cost of hedging those currencies. But it does give a useful tool for investors that want to adjust their exposure regarding currencies as well. So finally, just to talk about the index, for those of you who really want to get into the weeds, what you can see on the screen now is a list of all of the country classifications under FTSE's equity index systems. The three boxes on the left, so the developed, the advanced emerging, and the secondary emerging, are the countries that make up the constituents of the FTSE All-World Index. I mentioned the exclusion of frontier countries. That's the list that are on the right there that don't make it into the index. And then there's a few other standalone countries that don't either. And with that, I guess that brings the end of the formal part of the presentation. I'm more than happy to take questions or provide any further insight that you're looking for.
Yeah, thanks, Chris. I think there are some really powerful, interesting arguments for why we should all be investing globally and not just in a single region there. I particularly like the kind of core satellite approach that you were talking about, where you have this kind of all world as your core, and then some like thematic or some regional ETFs if you want to tilt your portfolio a little bit towards the areas of the market that you think might outperform. Just keep an eye on the time. We are coming in kind of towards the end of the webinar now, and I'm just conscious of time, so I'm going to do a quick platform run through in a second. But in the meantime, please, as Chris said, feel free to keep the questions coming. If we don't get a chance to answer them today, then we'll do our best to get back to you after the webinar. So yes, at this point, I'm sure everyone's thinking the research is very compelling. Investing globally sounds like a great way to go. But how do I actually invest in what Chris has been talking about? So I'm going to share my screen. I'm just trying to share my screen. Elspeth, would you mind enabling screen sharing, please? I've got an error popping up saying that host has disabled participant screen sharing, which is a bit of a spanner in the works for me. Aha, there we go. Thank you very much. Very responsive. Right, here we go. So I should be sharing my screen now. Yeah, I can see that pop up. Right. So we've got a dummy account to walk through here. This is a representation of what the platform looks like. Basically, once you're logged into the app on your phone or on the web browser, you can either open a new portfolio or you can select your existing one. So I'm just going to go ahead and select this imaginatively named DIY1 portfolio, which I've got set up here, which does have a couple of ETFs in there already. We're at 50% equity, 50% bonds as target weights. So if I wanted to stick in an ETF that kind of talks about what Chris has been presenting on today, I just click Add Securities, and very handily at the top here, we've got an Invesco banner, which we can click on, which brings up all the Invesco ETFs that we've got on the platform. You can see we've got an S&P 500 one here, this one, and the kind of hedged equivalent, which we've got down here. They're 5 basis points. They tend to be pretty popular on the platform, and a pretty popular choice for investors. But the one that we've been talking about today is the FTSE All-World ETF, which very conveniently for us is up at the top of the page. So we can click into that one, and then we can very simply click Add to Portfolio, and you can see in the top right here that is now included in the portfolio. And then we can continue on again, and this is where we adjust the weights. So I want to take out this fund and replace it with the Invesco FTSE All-World. It is cheaper, so I will review and continue. And here, yes, this is a cool feature of the platform. You can kind of see how the new portfolio looks after including this new ETF. You can see we're slightly increasing North America. On the sectors, we're slightly increasing industrial a little bit. And then if you drill through down to the holdings, we're keeping Microsoft the same, reducing Apple a little bit and increasing Nvidia just a smidgen. We then save and continue. And we should now be done. The target weights are now updated. So if we scroll down to the bottom of the page, which is our portfolio, you can see that this old fund has had the target weight reduced to 0. The Invesco fund is now up at half the portfolio, 50%. So all you have to do now is either fund the account, or if it's already funded like this one, you just need to rebalance to your new target weights, which is in here, options, and then rebalance portfolio. It is as easy as that. So with that, I'm going to stop sharing my screen, and we are bang on time at 25 to. And we've now got a few minutes to go through some of the questions from the audience with you, Chris. So let's have a look and see what we've got. Okay, I can instantly see we've got a couple of related questions here, so maybe it's best to kick off with those. I'll try and group them together. One of the questions is that the index provides kind of a lot of exposure to the US market. So can you really call it an all-world index? I guess the question is, is it so highly correlated to the S&P that they're basically the same? And then kind of related to that as a second question, has the US always been such a large part of the global index, and kind of how is that likely to change over time?
Yeah, so I guess the simple answer is that the construction of the index is market cap weighted. So the 60% weight in the US represents the size of the US equity market in the global market. Clearly, having 40% not in the US means that you're not just getting US equity market performance, although, of course, as we sort of saw with the correlation chart earlier, US equity market correlation with the UK market is it's positive, it's not negative, so there is going to be a linkage there. In terms of size, though, it's worth looking back at history. The US equity market hasn't always been 60% of the FTSE All-World Index. If we go back to say 2000, the mid 2000s, 2007 is the last data point that I looked at. Actually the US equity market made up around 40%, not 60% of the FTSE All-World Index. The reason it's grown in size is because of the outperformance of US equities and the growth in the size of the US market. So, if you get underperformance from US equities, you would expect that size to reduce. And what the ETF is doing, what the index is doing, is basically not taking a view on, which is the right one. It's just trying to give you a slice of the entire global equity market as it stands today, as a core exposure for your portfolio.
Yeah, and I think leading on to the answer to that one is a kind of similar question about the sector composition. So we've got a question. Somebody is asking that if the US tech stocks started crashing and dragging down the USA down, do you need to do anything with the fund, or does it just reduce in value and you don't have to do any buy or sell transactions?
Yeah, so if the US tech stocks were to crash tomorrow, the value of the fund would drop, because the weight of those stocks are, they're held and owned by the portfolio. What you won't get with a fund like this is you won't have the ability to sell Nvidia if you think it's doing badly or it's going to do badly. It will stay at its weight will reduce because of the price falling and because of the market cap falling.
Yeah.
But so you'll get a reduced exposure. But the point is that today you've only got 2% of your portfolio in Nvidia.
Yeah.
But there's no sort of active overlay that's possible.
It's just kind of set and forget.
Yeah, so you just buy it and don't worry about it.
Yeah. We've got a few questions that are all in a kind of similar vein. I'm not sure how much you'll be able to touch on this, bearing in mind compliance constraints. But just in terms of how this ETF differentiates itself from maybe some of the competitors' products out there, what do you think are some of the key differentiating kind of features of the...
Yeah, so the key, I guess the key difference in anything when you're looking at a fund is, what's going to drive the performance of the fund? Ultimately, what's the cost of getting my exposure? And that will be driven by a number of factors. The first and obvious factor is fees. So at 0.15%, the fees on this fund are, as you showed in the example, lower than other competing funds out there, which over the very long term, fees cost you, and I think it was I can't remember his name. It's been well observed that fees over the long term, if you don't have any additional insight, you can't add alpha or extra performance. Fees are the key you can control. So low cost is important. The other things that we obviously bring with the portfolio is a very long history in managing global equity portfolios. Invesco is one of the biggest asset managers in the world. It's the fourth largest ETF provider in the world, and our global team of portfolio managers and the other teams that sit behind them mean that we are very effective at managing these portfolios. And that knowledge helps to make sure that you're going to get what we hope is a good experience of that exposure.
Yeah, that makes sense. I'm not sure whether was it the John Bogle cost matters hypothesis you were maybe thinking of. The
other thing I'd add, by the way, is the final difference, I guess, from other competitors is in stock lending. So again, I don't know how much people are aware of how physical funds replicate an index, but one part of that for many physical ETFs is that they will lend stock to other market participants in a very controlled and managed way, with receiving collateral against what they're lending, but it's a way of increasing returns to the fund if you're lending stocks that are useful to other investors. The way the Invesco stock lending program works is 90% of all stock lending revenues go back to the fund. 10% is retained by the lending agent, which is a third-party company. For other providers, they don't necessarily give that same degree of share, shall we say, in terms of the revenues that come from stock lending.
And that should be accretive to your performance, right?
Yeah, so stock lending, it depends on the exposure, it depends on the period of the market, but it can help to offset or reduce the costs within the fund that would be normally borne by the fund, so it can help deliver better returns to the end investor.
Yeah. And just a question here on valuations. It's something we've talked about in a couple of previous webinars, on the managed webinar that we had about the managed portfolios. We're talking about valuations there, and it's come up again here. Someone's asking that CAPES valuations are high at the moment. So would you say now is a bad time to begin investing in equities because valuations are so high?
Well, it's a great question, and in fact, we're seeing new highs being reached in different markets. The US market is an obvious one, and certainly valuations in the US are looking relatively extended. I guess the key thing for any investor is the key question is can you continue to see new highs in markets? And the obvious answer is yes. There have been new highs in the past, and hitting a new high in the market doesn't mean it's going to fall tomorrow. From a valuation perspective, again, there's another advantage to using something like a broad global exposure like the FTSE All-World, which is that actually, while US equities are trading on high valuation multiples, the FTSE All-World index is trading at something like 17 times next year's earnings, which is slightly above the 15.5 times average that you've seen over the last 20 or so years, and significantly below the 25 times level that you saw towards the end of 2020. So valuations don't look particularly stretched on a global benchmark like the FTSE All-World.
Yeah, it makes sense. I think that's a good argument in favour of diversifying globally rather than just in the US. We've got a couple of questions. I'm just aware we're coming up to time. Finally, I appreciate you might not have the information off the top of your head here, but we've got a couple of people asking about tracking error, saying what is the fund's tracking error, and somebody else saying that the ETF is obviously quite new. So what has the tracking error been so far, and kind of how is it likely to progress as the fund builds up a track record?
Yeah, so I can't give you the tracking error number off the top of my head, but certainly what you what you tend to see from this type of fund is relatively tight tracking. It tends to be less tight tracking than physical US exposure, purely because you're adding in emerging market stocks, which tend to be a little more noisy and a little more difficult to track perfectly. Also, with a fund of this size, you tend to see a greater degree of tracking error when you're trying to match 4,300 stocks rather than 500 or 100. In terms of the development of the fund, as you say, we launched last year. It's grown since then to just over $180 million of assets under management. Obviously, as you grow in assets, the closer you're able to match the index that you're tracking, so you tend to expect to see a reduction in tracking error over time as the fund grows further. But we can certainly share the tracking error numbers with you after the call to share with the participants.
Yeah, thank you. And I guess also to add to that point, Invesco, this isn't a new idea for Invesco. Invesco's been running index tracking funds for donkey's years, so the process of tracking index, they're pretty expert at that.
Yeah, 100%.
Right, one final question. I've got a nice question for me before I wrap up. Someone's asking about the costs of switching ETFs. So in the example that I gave of switching the old equity fund into the Invesco ETF, how much would that cost in admin fees? And the answer is absolutely nothing. It's free. Transactions are free on the DIY platform for InvestEngine. So with that one, I'm afraid I've gone slightly over time. If we haven't answered your question today, we've actually had really good engagement. There's loads of questions coming through, but we will try and get back to you over the next few days. We tend to copy and paste all the questions that we get and go through them one by one afterwards. But in case you've got another question that you haven't managed to ask, you can always email support@investengine.com or post on the community forum that we have. And we can answer any questions that way. So all that leaves me to say is a big thank you to you, Chris, for your time today. That was a really interesting presentation. I mean, from the engagement, it seems like the audience has got a lot out of it. And yeah, if you want to find out more about Invesco's ETFs, just as you saw me do in the demo, click the Invesco banner at the top of our ETF range page, and you'll find all the details there. So thank you all for joining, and see you next time.
Thank you.